Welcome to the Deep Dive, the show where we take a massive stack of sources, articles, bios, research, and really just boil it all down into the concentrated knowledge you need.
We do the reading so you don't have to.
Exactly. We're here to shortcut your path to being well-informed. We give you the surprising facts, the context, everything you need to make it stick.
And our mission today is a big one. We are doing a deep dive into the world of Ray Dalio.
The billionaire founder of Bridgewater Associates. I mean, we are absolutely unpacking the architect of a true financial behemoth.
No question. Bridgewater was listed back in 2013 as the world's largest hedge fund. And when you look at Dalio today, what is it? A net worth of over $15 billion.
Last check, yeah. $15.4 billion, which puts him, firmly on that Forbes list of the wealthiest people in the world.
So this isn't just a story about money. It's really a story about the creation and maybe more importantly, the codification of a system.
That system is the absolute core of what we're looking at today. We're trying to extract those foundational principles, as he calls them, that drove his success.
And we're going to track that entire journey from the son of a jazz musician all the way to a financial oracle whose views are now shaping global policy debates.
On everything. Debt crises, wealth inequality, you name it.
Our source material today is really broad. We have biographical context. We have the detailed mechanics of his unique investment strategies.
Like pure alpha and risk parity, which we'll definitely need to break down.
Oh, for sure. And we also have a crucial look at his highly unconventional corporate culture and, some of the public controversies that followed his rise to the top.
We're going to trace this whole thing chronologically. I think that's the only way to do it.
I agree, because it shows how the man's early, maybe aggressive tendencies, let's say, arguably made it necessary for him to create this rigid, systematic philosophy that now governs his entire empire.
Okay, let's get into it. We have to start at the origin, because the contrast between his let's say, humble beginnings and his later status as this hyper-systematic financial titan. It's one of the most compelling parts of his story.
It really is. He was born Raymond Thomas Dalio in 1949, and his start was, it was decidedly not Wall Street elite.
Right, he's from Jackson Heights, Queens, New York City.
The family moved to Manhasset on Long Island when he was 8, but that immediate family environment was artistic, not financial. It was all about music.
His father, Ray Dalio, was an Italian-American jazz musician, and his mother, Anne, was a homemaker.
Think about that for a second. A jazz musician's son running the most systematic, algorithm-driven, massive hedge fund in the world.
It's an incredible generational leap in just professional temperament. It's almost the exact opposite.
It is, but the foundation for that system, it was built through some very early, very practical experience. He gets his bachelor's in finance from C.W. Post College of Long Island University.
And then, crucially, after graduating from C.W. Post, he takes this very practical entry-level job.
Right, he's working as a clerk right on the floor of the New York Stock Exchange.
Can you imagine that? That hands-on experience, seeing the raw, visceral mechanics of the market, the paper, the shouting, the pure human element.
It must have been an incredible contrast to the later clean, data-driven approach he became famous for.
It's the difference between seeing a raw diamond and the final polished gem. He saw the chaos first.
Exactly. And he combined that sort of street-level market understanding with the academic rigor of an MBA from Harvard Business School, which he got in 1973.
The best of both worlds, really. The theory and the practice.
And after Harvard, he moves to Wilton, Connecticut, and he starts trading commodity futures, famously operating out of a converted barn.
Again, with the contrast.
Yeah.
The rustic setting and the sophisticated financial instrument, it's an early sign of that independent streak.
Totally. But before he really launches his own thing, he did work in the established financial industry. He was director of commodities at a place called Dominick and Dominick.
And then he moved to Shearson Hayden Stone.
Yeah.
That was a major securities firm at the time, run by the legendary Sandy Weil.
And his job there, his core function, was so critical to what came later. He wasn't just a speculator, betting on prices.
No, he was advising real-world producers, cattle ranchers, grain farmers.
Exactly. Advising them on how to use futures contracts to hedge their risks. He was mastering applied risk management, translating market volatility into predictable costs for businesses.
You can see the seed of the all-weather fund right there, decades before it even existed.
It's all there. He was building this incredibly specialized skill set and, just as importantly, a deep, loyal client network.
His time at Shearson Hayden Stone ended in a way that provides this incredible essential bit of narrative friction for his entire career.
The famous firing story, it's a remarkable anecdote because it feels so completely opposed to the disciplined, systematic image of Dalio we have today.
So what happened?
It's 1974. He gets fired from Shearson Haydenstone. The reason? He punched his boss in the face while he was drunk at a New Year's Eve party.
Wait, let's just pause on that image for a second. The man who would later champion radical transparency and believability-weighted decision-making.
Systems explicitly designed to strip human emotion and bias out of professional conduct.
That guy was once so prone to volatile emotional outbursts that he physically attacked his superior at a holiday party. That is just astonishing.
It completely underscores the idea that his later principles weren't just some intellectual exercise. They were, you could argue, a necessary survival mechanism for him.
What do you mean?
Well, he clearly had a massive temper problem, and that volatility, that very human flaw, it cost him his job.
Yeah.
If you want to achieve what he achieved in such a high-stakes environment, you can't afford that kind of emotional error.
So if you look at the principles as a system designed to regulate human behavior, it makes perfect sense. The most important principle of all is the one that forces you to examine your failures and eliminate emotional decision-making.
Precisely. The system is the professional safeguard against the very person Ray Dalio was in 1974.
So that need for control, for systematization, it was born directly from his own chaos and failure.
Absolutely. He was suddenly jobless, but he still had his specialized knowledge and, crucially, the trust of those corporate clients he had been advising. So, necessity being the mother of invention. In 1975, he launches Bridgewater Associates.
From his two-bedroom New York City apartment. Not exactly a Wall Street skyscraper.
Not at all. And it wasn't initially the hedge fund it became. It started as a wealth advisory firm. And the genius move that allowed him to launch it immediately was retaining those existing corporate clients.
Cattle ranchers, the farmers.
Yeah.
They all still needed his hedging services.
That existing revenue stream was the foundation. But to scale beyond just advisory work, he started publishing a paid subscription research report. It was called Daily Observations.
So this was his way of formalizing his macro insights and building a brand as a thought leader, not just a broker.
You got it. And then came the true inflection point, the big break that moved him from a boutique advisory shop to a real institutional player. McDonald's signed on as a client. Securing a massive, globally recognized corporation like that was the signal Wall Street needed to pay attention.
And after that, the firm just striked it. It grew rapidly, securing even larger, more complex clients.
The pension funds for the World Bank, giants like Eastman Kodak, he was in the big leagues now.
That's exponential growth, and it was fueled by deep specialization and that credibility he built. From a two-bedroom apartment advising on cattle futures to managing billions for the World Bank.
By 1981, the firm needed infrastructure to match its client base. Coincidentally, Dalio and his wife decided they wanted to start a family in a more suburban environment.
So they opened a dedicated office in Westport, Connecticut.
And that physical move really solidified Bridgewater's transformation. It went from a personal shop into a structured institution ready for its systematic ascent.
Okay, so the move to Connecticut marks the beginning of Bridgewater's systemic rise. And it was driven not by, say, stock picking, but by these rigorous macroeconomic insights.
Exactly. Let's look at the key moments that launched him from being just a successful manager to a full-blown financial oracle.
The first major external validation that came after the 1987 stock market crash.
That's the one. While so many firms were just devastated, Dalio gained significant visibility outside of specialized circles because he actually turned a profit during all that turmoil.
It was a massive validation of his focus on risk management and his ability to see opportunities in crisis.
And this success leads directly to the formal codification of his investment approach. In 1991, he launches Bridgewater's flagship strategy, Pure Alpha.
Let's make sure we clearly define alpha for everyone listening because it's so fundamental to his firm's whole identity.
Good call. So, in simple Wall Street terms, the total return of any investment can be broken down into two parts, beta and alpha.
Beta is the easy one. That's the return you get just for taking on market risk. If the S&P 500 goes up 10%, that's your beta.
Right. Alpha, on the other hand, is the excess return that's generated by the skill or the timing or the unique insights of the money manager beyond what the market delivered. It's the secret sauce.
So by naming his fund Pure Alpha, he was making a massive claim. He was basically saying, We deliver returns solely based on our intellectual edge and our strategy, regardless of whether the overall market goes up, down, or sideways.
Exactly. The goal was to be uncorrelated to the broader market by using diverse asset classes, global markets, sophisticated instruments, all to capture that pure skill-based return.
And clearly, the execution was effective enough that by 2005, Bridgewater Associates had officially become the world's largest hedge fund.
The largest. But the moment that truly cemented his status as a kind of seer that came 2 years later.
2007.
Yep. Bridgewater famously predicted the impending 2008 financial crisis.
And successfully anticipating a systemic global collapse of that magnitude that moved you from being a successful financial player to someone whose intellectual framework demands international attention.
That recognition led to this huge rise in influence. He was named to the annual Time 100 list in 2012. Bloomberg Markets listed him as one of the 50 most influential people in both 2011 and 2012.
It solidified this idea that his strategies held lessons that went far beyond just trading.
So let's get into the engine room now and talk about the specific strategies. First, let's define Bridgewater's structure.
Okay, Bridgewater is defined as a global macro firm. That sounds fancy, but what does it actually mean they invest in?
It means they're not focused on the micro details of individual companies, like whether Apple or Ford had a good quarter.
Right.
They invest based on large systemic economic trends, massive shifts in GDP growth, movements in exchange rates, central bank policies, changes in inflation.
So they're making these huge long-term bets on how the entire global economy is going to evolve.
That's it. And they primarily focus on currency and fixed income markets, bonds and interest rates.
Why those two areas specifically?
It's all about scale and liquidity. Currencies and government bonds are the deepest, most liquid markets on the entire planet.
So if you're the world's largest hedge fund and you need to deploy tens or even hundreds of billions of dollars, you can't really do that in smaller markets without moving the price.
You'd move the price against yourself, exactly. These markets allow them to take massive systemic positions without causing a ripple.
Okay, so pure alpha is about the skill of their picks. But the strategy that Ray Dalio truly pioneered and popularized for institutional investors, that's the one behind the all-weather fund. Risk parity.
Yes. We need to spend some real time here because this is often the most misunderstood concept.
I agree.
Risk parity is a low-risk strategy. It's focused on diversification and risk management, which Dalio championed with the all-weather fund launched in '96.
The core concept here, and correct me if I'm wrong, is that you're not allocating equal capital to different assets. You're structuring a portfolio so that each asset class, stocks, bonds, commodities, gold, contributes the same amount of risk.
You got it. The same amount of volatility to the portfolio's overall expected returns.
Let's use an analogy to make this really clear for everyone.
Okay. Imagine your investment portfolio is a four-legged table. Each leg is an asset class. Stocks, long-term government bonds, commodities, and maybe some inflation-linked securities.
In a standard portfolio, like a 60-40, the stock market leg is way longer and much wobbier than the others. It carries, what, maybe 80% of the risk? So if stocks fall, your whole table collapses.
Exactly. The risk contribution is heavily skewed toward the volatile equities. Risk parity tries to balance that table. We know that bonds are inherently far less volatile than stocks. So to make sure the bond leg contributes the same amount of risk as the stock leg, you have to hold a much larger notional dollar amount of bonds. You use some leverage on the less volatile assets so that they have an equivalent risk profile to the more volatile assets.
So you might only put, say, 10% of your capital into volatile stocks, but you might use financial instruments to give yourself 70% notional exposure to long-term bonds.
Yeah.
Because you need that high dollar value to make the bond's low volatility equal the stock's high volatility.
That's the functional explanation. The total portfolio is balanced by risk contribution, not by capital.
And the benefit is that this all-weather portfolio performs adequately in 4 different economic environments.
Rising inflation, falling inflation, fast growth, and slow growth.
Yeah.
A recession. You're never relying on one single economic outcome to succeed.
It's the ultimate expression of that systematic thinking he had to adopt after the volatility of his own early career. It's like systematized humility. You're admitting you can't predict the future, so you have to prepare for all possible futures.
And this systematic approach extended into how he defined market events. When the 2008 crisis hit, he realized pretty quickly it wasn't just a severe recession.
This is when he coined the term D-process.
Right. In February 2009, he started using that term. It stands for the deleveraging and deflationary nature of the subprime mortgage collapse.
And what's the difference? Why was that distinction so important?
A standard recession might involve high unemployment and slowing growth, but the D process involved the massive, simultaneous unwinding of global debt.
Ah.
This meant that the usual policy tools, like just lowering interest rates, were much less effective.
So if you recognize it as a D process, your portfolio has to be structured completely differently.
Absolutely. It meant Bridgewater moved heavily into assets that benefit from deleveraging and a flight to safety like U.S. government bonds, and they shifted away from assets that are highly dependent on credit expansion.
That precise, codified language allowed his systematic models to function correctly and avoid the errors of managers who were just treating it like a normal cyclical downturn.
And that systematic approach applies just as much to corporate governance. Dalio controlled the firm alongside his co-chief investment officers, Bob Prince and Greg Jensen, since the beginning. But as the system matured, he began this long process of transitioning his own role.
He served as co-CEO for about 10 months, and then in March 2017, he announced he was stepping down. It was part of this big, multi-year, company-wide shakeup.
This was him prioritizing the longevity of the system over his own personal control of the management structure. He wanted the machine to be able to run without him.
And here's the crucial detail that really defines his final legacy, a detail we noted earlier. Dalio sold his last remaining shares in the hedge fund in 2025.
That move is so profound.
It is. It means the founder, the driving intellectual force, has entirely separated his own financial interests from the operational engine of Bridgewater Associates.
He's transitioned from being the owner and operator to being more of a spiritual and philosophical leader whose systems are just. They're enshrined in the firm's operations.
This systematic approach to investment risk wasn't just contained to the trading floor, though. Dalio realized that the greatest risk to any organization, or any individual for that matter, was human emotion and behavioral error.
Which is what led him to codify the very philosophy that governs everything he does. Let's talk about his literary output.
Right. His 2017 book, Principles, Life and Work, is maybe his most enduring public legacy outside of the markets themselves.
It outlines his investment philosophy, sure, but it also lays out the radical corporate management philosophy of Bridgewater. It became a phenomenon. A New York Times #1 bestseller, Amazon's #1 business book of 2017.
This book is what introduced the world to concepts like radical transparency.
Where meeting notes and performance reviews are often taped and shared with staff.
Can you even imagine working in that kind of environment? And then there's believability-weighted decision-making.
It's intense. Radical transparency is designed to ensure that everyone, regardless of rank, can offer criticism. But those criticisms are tempered by this believability weighting.
Which is the idea that the weight given to someone's opinion should be proportional to their proven track record of success in that specific area.
It's a meritocracy of ideas, codified to prevent hierarchical stagnation or emotional groupthink. It is a direct, systematic antidote to the kind of emotional outburst that got him fired back in 1974.
Fascinating. But his intellectual interests, they quickly expanded from just corporate management into these deep historical and global economic cycles. It reflects his global macro focus.
That's right. His later works provide a real foundational understanding of his entire worldview. We had How the Economic Machine Works way back in 2007.
And then after the crisis, there was Principles for Navigating Big Debt Crises in 2018. That book was basically a historical template showing how similar crises have played out over centuries.
And as his focus shifted to geopolitics and long-term history, we saw the book that became maybe the most relevant to current events, The Changing World Order: Why Nations Succeed and Fail in 2021.
And that theme of cyclical analysis of debt, power, and national success continues in future work, How Countries Go Broke. The Big Cycle, which hit the bestseller list in 2025.
He even applied this same systematic approach to the individual. In 2021, he produced a free online personality assessment called Principles U.
It's a public manifestation of his deep-seated belief that objective self-knowledge, understanding your own biases, your weaknesses, your behavioral tendencies, is the ultimate prerequisite for successful decision-making.
In markets and in life.
Let's turn to his public views on global economics and policy, because they're complex and often really surprising. Here's a man who has benefited immensely from the current financial system, yet he's become one of its most vocal critics, demanding reform.
He's always careful to state that capitalism is generally the best economic system, but he argues forcefully that its current version is fundamentally broken and requires significant reform.
This really peaked in 2019 when he called wealth inequality a national emergency. I mean, that's a powerful, almost politically charged statement coming from the head of the world's largest hedge fund.
He doubled down on it in May 2020, stressing the urgency of reforming, not abandoning the system.
And he didn't just issue these vague complaints. He was specific about the necessary reforms, linking them directly to productivity and opportunity.
Right. He argues the system is failing because monetary policy, like low interest rates, it only really benefits asset owners. That just exacerbates the wealth gap.
Meanwhile, productivity and educational outcomes are stagnant for the majority of the population.
So he's advocating for a systematic approach to fixing society, similar to how he'd fix a portfolio. Diversify the risk and invest in the productive base. He suggests reforming the system by focusing on massive, targeted investments in education and infrastructure.
To raise the productivity of the bottom 60% of the population.
His views also stretch globally, linking back to his changing world order thesis. In October 2020, he issued this stark caution to global investors and policymakers.
Don't be blind to China's rise.
Exactly. He sees this shift in geopolitical power as a key input for his investment strategies. He argues that China is rapidly emerging as a financial and technological superpower, and that requires a major reassessment of risk and allocation by Western institutions.
Now, we absolutely have to address the controversy. Because for a firm that has staked its entire reputation on systematic, emotionless processes, the machine, there was a major investigative report that questioned the very foundation of that methodology.
Yes, a November 2023 New York Times investigative report. It raised some really serious questions about the inner workings of Bridgewater. We have to review these findings impartially as they exist in our sources because they challenge the very core of Dalio's legacy, the primacy of the system.
So what were the two main high-stakes claims that this investigation leveled against Bridgewater's operations?
The first claim was that despite all the public marketing of this sophisticated, objective, systemized investment process run by algorithms, the fund's actual investment choices were based largely on Ray Dalio's personal picks.
Wow.
Which, if true, challenges the entire myth of the machine and suggests that the brilliance of the individual was still the primary driver of returns.
That claim is massive. If it's true, then the principles were maybe more of a sophisticated corporate culture, a way to manage people, than an actual purely automated investment structure. What was the second claim?
The second claim was that investment choices were allegedly driven by legally obtained insider information derived from Dalio's extensive personal associations with prominent government and political actors.
The implication there being that his access and his network, the human element, gave him an informational edge that the algorithm simply processed, rather than the algorithm generating the insight itself.
And the response from Dalio's lawyers was swift and strong. They threatened a multi-billion-dollar lawsuit against the publisher, Macmillan, over what they alleged was an inaccurate portrayal.
But threatening a massive lawsuit doesn't disprove the underlying claims. It just underscores how critical that systemic reputation is to Bridgewater's entire business model.
Absolutely. The entire brand, the ability to market the principles, the all-weather fund, it's all tied to the infallibility of the system.
So if investors believe the genius was just the man and his network, and not this transferable immortal system, the firm's long-term value would plummet. It's a battle over narrative control.
And this tension forces the most critical question. How much of Dalio's generational success was genuinely the system, and how much was the man behind the system, just using the principles as a highly effective operating philosophy for himself?
Okay, moving beyond the controversies and the mechanics of the market, his personal life provides some of the humanizing context for this intense dedication to systematization.
It does. He lives in Greenwich, Connecticut with his wife Barbara, who is a descendant of the sculptor Gertrude Vanderbilt Whitney.
An artistic connection, just like his father. They have 4 sons, but their family life has also been marked by real tragedy.
Yes, their oldest son, Devin, tragically died in an automobile accident in 2020. He was only 42.
It's just awful. One of their other sons, though, Paul Dalio, has pursued a creative path. He's a film director.
Which is a wonderful echo of Dalio's own father, the jazz musician.
And when we look at his personal habits, there's one non-financial practice he credits almost entirely for his ability to maintain high performance under such immense pressure.
That would be his steadfast practice of transcendental meditation, or TM.
He has publicly called it the single most important reason for his professional success.
And it makes sense. It's the ultimate systematic approach to managing his internal environment, right? It allows him to maintain the objectivity required by his principles. It's the perfect counterbalance to the high-stress, high-stakes world of global finance.
It creates a fascinating duality, especially when you pair it with his main hobby.
Which
The
is,
man who meditates religiously and codifies every aspect of his professional life is also fond of bow hunting.
that contrast, the meditative piece and the primal focus of the hunt, it really highlights his complex temperament. He balances extreme control with these very high-focus, singular activities.
Let's discuss his massive shift into philanthropy, because it mirrors his investment strategy in so many ways. It's systematic, it's immense in scale, and is focused on systemic risk.
Since joining the Giving Pledge in April 2011, he and his wife have committed to donating more than half of their fortune. And the scale is just staggering.
What are the numbers?
The Dalio family has donated over $5 billion overall to the Dalio Foundation, which in turn has distributed over $1 billion in charitable grants. This is wealth mobilization on the scale of a sovereign nation.
And just like his global macro investments, his giving is focused on large systemic issues, starting with health justice and the massive shock of the COVID-19 pandemic.
He joined the board of trustees at New York Presbyterian Hospital in 2020, and that same year he committed $50 million to launch the Dalio Center for Health Justice at NYP.
And that center is explicitly designed to address systemic healthcare injustice, applying his analytical framework to public health outcomes.
During the peak of the 2020 pandemic, his foundation was active everywhere. $10 million to support China's coronavirus recovery, $4 million to the state of Connecticut for healthcare and nutrition.
Beyond health and also education, he pledged $100 million to Connecticut public schools in 2019. His most visually exciting philanthropic endeavor has got to be OceanX.
The organization dedicated to ocean exploration and conservation.
This initiative, done in partnership with Bloomberg Philanthropies, involved a commitment of $185 million over 4 years to protect the oceans. The source material frames this almost like he's running a massive financial analysis on the health of the planet.
The methods they use are highly technological and systematic. OceanX uses advanced infrastructure, including Dalio's own specialized research yacht and submersible vehicles.
And there are these wonderful, almost cinematic details in the sources. His research yacht and submarine have appeared on the Discovery Channel during Shark Week.
And they've been used in these highly publicized attempts to hunt for a giant squid. It showcases the systematic application of vast financial and technological resources to pure scientific discovery.
It's the ultimate scaling of his methodology. He's taking the capital and the systematic research processes that were developed for predicting market cycles and applying them to predicting and mitigating societal and ecological crises.
The foundation's reach is so broad, supporting groups like the Fund for Teachers, the Davis Lynch Foundation, which connects back to his TM practice, and TED's Audacious Project. He also backed the Volcker Alliance Public Policy Group, which links him into the highest circles of former Federal Reserve leadership.
What really stands out is that transition from obsessively managing the risk in capital markets to systematically addressing systemic societal risk.
It's the same brain, just applied to a different problem set.
So we've completed the full arc of Ray Dalio's life, from the son of a jazz musician who was, volatile enough to punch his boss and get himself fired.
To the head of the world's largest hedge fund.
And his journey was entirely defined by the creation of this rigorous, codified philosophy he called principles.
The core insight for you, the listener, is the realization that Dalio's brilliance was in recognizing that predictability and success come from the system, not from individual genius.
He didn't just recognize market trends like the D process. He built these strict, repeatable principles to govern investment, management, and even his own personal behavior.
And in his third act, that same systematic approach has been successfully translated into massive philanthropic influence. He's aiming to reform capitalism, ensure health, justice, and preserve the oceans.
He's using the infrastructure of a financial titan to solve global challenges.
But we have to return to that fundamental tension. We noted the New York Times investigation suggested his success might have been driven more by his personal insights and network, the genius of the man, than by this mythical, purely automated machine.
And then there is that final, undeniable detail. Dalio sold his last remaining shares in Bridgewater in 2025. He is now financially separate from the engine that he created.
So what does all this mean, especially when you consider that controversy?
It raises a really important question, something for you to mull over in your own explorations. What does the ultimate separation of the legendary investor from the firm he built tell us about the ultimate importance of systems versus individuals in creating generational wealth.
If the machine Dalio created continues to thrive without his financial stake, and yet the controversy suggests the machine needed the man to begin with, does that mean the principles themselves were the greatest, most successful investment product of all, regardless of what actually drove the returns?
The man is gone, but the operating system remains.